Good morning, everybody. You're watching SmallCapSteve Live. I am SmallCapSteve. Thrilled you could all join us. We're trying Twitter Media Studio as opposed to Periscope this morning. Let's see how that works out. Lots of news in the last 72 hours from Jay Powell on 60 Minutes. Afria putting out earnings. Clearly, there's a lot of saltiness on the Twitter sphere over those earnings. Tesla just got upgraded by Canaccord thanks to their energy storage capability. So that's going to be interesting to talk about. As you guys know how much I love Iguana Technologies, a little micro cap here out of Canada. Trulieve raised a ton of money. Talking broad market here. The 10 years up a tiny bit. It's in terms of the yield, so the prices are down. Gold's down, silver's down, oil's up, lumber's up. Getting used to saying that every day. No guest. It's just going to be me and Jay talking small caps. So buckle up. Jason, sweet Jason, welcome to SmallCapSteve Live.
Good morning, good morning. How's she going today? How's the weekend? What'd you do?
This weekend, I worked a lot this weekend.
Yeah, that's surprising. I for those of you that don't know, I give Steve shit literally every Friday, telling him to stay away from the frickin' desk, and the guy doesn't like to listen. Surprise, surprise.
Yeah, so I pretty much I worked all weekend. I love what I do. Last night I watched Jay Powell's appearance on 60 Minutes. That was fun. It's funny because I watched it and I was like, okay, he's effectively saying nothing. Like he doesn't know how this whole, because this is all an experiment, right? Everything that's happened since COVID started, all of this, these new acronyms that the Fed created, all of this money printing, we've expanded the M2 25% in 1 year. Sending checks to people in the mail, asking them to sit on their butts. Now we're going to see what happens here as the economy comes back online. I think certain sectors have found ways to be even more productive, which is really strange. I don't know that any of us were really expecting that to happen, and clearly it did. So now we've got certain sectors are more productive. And then we've got a whole bunch of sectors that were effectively doing nothing for the last year. They're starting to come back online. The cyclicals, as we call them in the biz. We're going to see how hot inflation rides. Did you watch Jay Powell last night, Jay?
No, well, you and I think Hermina was actually watching it with you. While you guys were doing that, I was doing some editing, getting stuff scheduled for today. I have no idea what came of it, but I didn't see any big headlines, so I imagine it was rather useless overall. Not
great insights. Look, I put you on the spot asking you to talk about something you don't care about. I care about this a lot more than you do, but I know something that you do care about. That's a little company out of Leamington, Ontario called
just a small little company that continues to meet expectations of the disaster that is the Canadian cannabis market.
So let me pull up the news release.
Pull it up and let's get into it. And then, you know what? We'll talk Jay Powell after, and I'll quiz you on what happened on 60 Minutes.
Sounds good.
Alrighty, so Afria this morning. Most of you probably already know that they shit the bed. That's really what it is. They did not came nowhere near hitting analyst consensus estimates, which is always interesting to me because we all know how consensus estimates are really formed. Analysts talk very closely with management 9 times out of 10, and results were nowhere near expected. So 153.6 million in revenues. Analysts were expecting 170 million, and a net loss of 361 million. Now that net loss is largely related to convertible debentures, and it's just accounting work rather than actual actions of the business. But let's face it doesn't even matter. Like, the results were terrible. They lost money, unless you want to go to the whole adjusted EBITDA basis, which by now everyone knows my feelings on that. Net revenues were down 4.3% quarter over quarter. The only thing that was up on a quarterly basis was their craft alcohol or beverage alcohol, whatever you want to call it there. And that's simply because last quarter they couldn't recognize the full revenue because of the timing of the acquisition. Cannabis revenue actually created, or distribution revenue was down quite a bit. There really was nothing positive out of these earnings. People were expecting a lot. The name's been crushed this morning, 13%. What was the low on it? 1735 by the looks of it.
Let me pull up the one day. You'll all notice that I spent part of my weekend learning how to use new charting software.
After being embarrassed on Friday. But yeah, just do me a favor and pull up the 1 year like you had there before. I think it was.
You want the 1 year? Here you go. There you go, Jason. Look at this. We're charters now. Chartists?
Like, just look at that chart. Afria took longer than the others because it had a strong following behind it, but that following this morning has fallen apart like no other. And the reality is they're losing market share, right? The company tried to blame COVID-19 on everything, despite the fact that sales were up in terms of the broader cannabis market over the last 12 months, right? So they're grasping at straws and they're just failing is really what it is. It's easy to see now why they're merging with Tilray. I mean, on a technical level, Tilray is being bought out, except Afria is vending into Tilray for some reason, losing Canadian listing. It's a very weird transaction to me. I don't fully understand it on really any level. So
I've never been a fan of Afria. I've always been pretty clear about that. I don't like Canadian cannabis companies, period. It became very, for me, I had a little bit of hope, a smidget of hope, right? A smidget, if I may. And that smidget was totally crushed. There was one quarter, it was the first quarter after legalization where it was one of the last quarters that represented just medical, and Canopy missed analyst earnings by a massive margin. I mean, Bruce got on CNBC and BNN Bloomberg the next day and said, oh, look, maybe I didn't do a great job of guiding to the analyst expectations. Meanwhile, he knew what he did. And it was clear that if we can't get this last quarter of medical right, oh boy, are we going to miss it on the fucking wreck, because this has just basically been a whole bunch of promises that are just not meant to be. So I know Afria, they were considered sort of the adults in the room in some regards. Very great looking, like phenomenal looking financial statements. I mean, I'm sure that you get a kick out of reading them, but in the end, you're selling a commodity. You're trying to get these multiples that demonstrate that you have a brand, that you have a moat, that you have a reason that we ought to pay a high multiple in valuation terms for said revenue, so for said cash flow, but they don't even make cash flow. What they do in operating cash flow?
Operating cash flow, I can't remember off the top of my head. It wasn't great.
It was negative, I assume.
It's either negative or it's like 1.3 million. I can't remember if it was negative or positive to be.
Well, let me.
I could be entirely off base here. This was the first thing I covered this morning, so naturally I was half asleep. One thing I will say is, as Matt Lamers over at, I think it's Lamers, might be Lammers. I apologize. I'm going to be wrong on it. One thing he pointed out, he's from MJ Biz Daily, and he's been pretty spicy this morning on Twitter with the earnings. Afria isn't even a cannabis company anymore. 45% of the revenues came from the cannabis segment. So what are they? They're a distribution / craft beer operation, I guess. So this whole notion that they're this great cannabis company is so false, because the revenues from cannabis are minuscule.
Well, here you go. This is it. Your operating cash flow statement for the last 9 months, they lost $64.7 million. And they're like, look,
last 9 months, like,
we're pretty far into full wreck now, right? Like it's there's still a lot of revenue to be had. There's a lot of market share to be fought for as it grows, but this is what it is. How do you what's Afria's valuation right now at? Like what's the market cap?
Several billion. Excuse my keyboard.
According to TradingView, it's at $6.5 billion. $6.5 billion for a company that they can't generate cash flow. And they're selling a commodity. So at what point are they going to generate any cash flow?
Yeah. I'm trying to see. I think they broke out their net income so for the 3 months, they have an adjusted net income of only negative 47 million once they back out a bunch of garbage. But I mean, it's garbage in, garbage out.
I'll throw it up. There's your income statement, folks.
I thought they had broken out in their news release the cannabis segment specifically, but I must be wrong on that.
It's
adjusted cannabis gross margin 39.2%, adjusted cannabis gross profit 20 million. I mean, you can adjust shit all you want, but who cares, right?
Look, it is what it is. If you're long Afri, I'm not trying to make you feel bad. I've just never understood this thing. I quite frankly, I don't understand why anybody owns any of the cannabis operators here in Canada. And I mean, we probably have a few clients that we have coverage on. I don't really love the space. I suppose that there's a chance that a few of them are going to work out. Afria, I know for some reason everybody seems to love them. And perhaps they might be what was the analogy that the buddy we had the fund manager from the MSOs on, who also runs the YOLO fund, of which has a big position in Africa, and he used effectively the best house in a bad neighborhood analogy.
Yeah, like here's the thing. The honest truth is I would have a lot more hope for someone that came out and started their operations in the last 12 months than someone like Campy or Afria. Campy and Afria have been at this since the early 2010s, and look at where they are. They still have yet to actually earn money. They can't seem to do it. And if you can't do it after this long, are they ever going to in Canada? Like, it's a genuine question. I know people don't like to think about it because you only want to be positive on your longs or whatever, but sometimes you have to face the music and go, this just isn't working. The thesis broke down somewhere. Where is it? And you analyze where you went wrong and you move on.
On. Okay. Well, look, speaking of moving on, let's move on to Emerita Resources. They launched their initial 5,000 meter drill at is it Iberia West?
I believe that's how it's pronounced, yes.
Okay. So what can you tell us?
Disclosure, they're a client. I'll be open about it. So Emerita, they've got several projects over in Spain focused primarily on base metals such as zinc. Excuse me. Today they announced that they'll be doing an initial 5,000 meter drill campaign. They were very clear on the initial, so I don't know if that is effectively signaling to the market that they plan to expand that down the road later this year or what. 30-hole program. They're going to, I think it's somewhere along the lines of 300 meters of depth, along 1.2 kilometers of strike.
Pretty deep
as they look to basically form out their initial resource estimate for the property. Mobilization has begun on it. Outside of that, they also announced this morning some positive developments just in the region in general. First and foremost is underground mining has been declared a strategic industry within the region. So that makes things a lot easier for them from a permitting perspective, as well as the European Union likes this region of Spain so much that they're investing 3.1 billion into mine development in the region. So both positives for Emerita. They do have a couple large properties that are chugging along the development stages. This one here in particular has 49 historic drill holes on it. Some numbers, 31% zinc over 3.5 meters, 25% over 5, and 12.3 over... Oh, I can't see it there because you guys scroll down a bit. But it's solid nonetheless in terms of 12 over 13 there. Thanks, Steve. It's solid in terms of there seems to be plenty of zinc in the region, and this is a region that has been mined since Roman times because it has so many different base metals. So it's all positive.
Yeah, so it's all positive. Okay, let's move on to something a little different here. Trulieve. I saw Trulieve in the news this morning. $287.5 million financing with U.S.-based investors. It's coming, folks. The institutional investors are coming for you.
I like how you have that at your desk there. So yeah, Truly, quick little release this morning. They sold 5.75 million shares at a price of $50 per share for gross proceeds of 287.5 million Canadian. Largely, that offering consisted of U.S. investors, which was notably their first such offering that has U.S. investors involved, at least directly in this manner. Solid little release. They put it out 5 minutes before the open this morning. They weren't too promotional about it, at least compared to Green Thumb when they did their first U.S.-based issuance. So, yeah, seems like they just keep on churning along, and they're getting after it.
Okay.
Not a lot to say on that.
Mm-hmm. So let's get into some of the other stuff that was in the news here that I found particularly of interest. Tesla to conquer the $1 trillion energy market, Canaccord says. Oh God, you're having a fun morning, I see. Okay,
what's Tesla going to conquer in the $1 trillion energy?
Hey! This is good news for me. They've given me something to let everybody know how amazing Iguana Technologies is, so I'm going to run with it. Okay, Jason. Tesla is set to attack and conquer another $1 trillion market as the company, best known for its electric vehicles, ramps up its focus on energy generation and storage, according to the great Canaccord.
As they ramp up its focus on energy generation and storage, this is a division that has just died since the acquisition of Solar City. It's done nothing positive. There's people on wait lists for 8 months, and now Tesla last week announced that they're increasing the price of things by like 30-some%. Despite being on the wait list, people are still on the hook for this new price.
Okay, we get it. We get it. You're jelly of
it's a pile.
We get it. You're just jelly of Kathy Wood, aren't you?
Tesla is the best orchestrated pump job in the history of everything, bar none.
Analyst Jed, not to be confused with Jeb, Jed Dorsheimer, upgraded the stock to buy and hold and gave it one of the highest
from hold
to buy from hold and gave it. I drank too much coffee today and I'm a little bit out of it. And gave it one of the highest price targets on the street, predicting the generation and storage unit could yield $8 billion of revenue by 2025. That's a big target. Tesla has rapidly created an Apple-esque ecosystem of energy products harmonized in electrification to become the brand in energy storage, Dorsheimer said in a note to clients Monday. His $1,071 a share objective, up from $419 per. How do you do that? 155% upgrade. Suggests almost 60% upside for a stock that's already gained nearly sixfold in the past year. The company's shares traded nearly 2% higher at $690.23 earlier in the morning. Let's take a look at how the stock is faring this morning, Jason.
It's up 3%.
Well, now that we got charting software, let's pull it up here.
How can the analysts seriously upgrade from 490 to 1071? Like, who approves of that? Like analysts should be held to some standard, you would think.
There is no standard.
Like, as long as you take this course and get this designation, you can put out whatever fucking price target you'd like with no bearing on reality.
Jay, sometimes I get concerned here that you forget that this is 2021, man. You make price targets and then you figure out how to justify them later.
Like,
oh boy, it's like
not your grandfather's market.
You don't know how us kids do equity analysis these days.
How's Sundial working?
Look, Sundial.
What's Sundial at? What's Sundial at?
It's at it's doing okay. It's 94 cents. 94 cents. I'm 1 cent in the green.
You wrote it all the way up and all the way down. Classic small cap.
So you can see Tesla's chart here. Tesla really seemingly took off there in 2020 based on this chart here. We're at January 2020. It just totally ripped. And we can see that takes it to a market cap today of around $671 billion. This becomes my problem with Tesla if I am thinking about Tesla as a long. And I would have said this at $200. Where's my upside? How many cars do they have to sell or data do they have to take advantage of in order to justify this thing going up from here? That's my issue with it. Like, you don't think that GM can make a good electric car? You don't think Toyota can do it?
It's all about option gamma. That's all you gotta do, Steve. That's your upside.
Option gamma. Okay. Well, so all you got to do is you buy shares of Tesla, you join a fraternity, and you get drunk, you make some memes, and you join the Tesla option gamma frat. Is that what we should call it?
Sure, let's go with that.
We'll start selling T-shirts.
Original GameSpot.
Isn't it GameStop?
GameStop? I don't know. Whatever it is. It's a Monday morning. Give me a break. I'm having my first cup of coffee on the air. So
you're really having your first cup of coffee of the day at I know you operate on Toronto time out there in Saskatchewan at 12:30.
12:30? Yeah. Exactly. Okay. I don't have I get up and I hit the ground running. I don't have time to make a pot of coffee.
Okay, so let's move on here. What else is in the news that has me excited? Okay,
so tell me about Jay Powell.
Jay Powell. Well, look, we're gonna get there. We're gonna.
Okay.
I have this show planned out. Well, you're sitting around driving around on your ATVs or whatever it is you guys do out in the country,
side by sides,
whatever that means. I'm sitting around planning my shows. Okay, so here we go. A hidden bond market problem. Sorry.
How much coffee have you had?
I've had too much. My wife started drinking more, and it really threw off the coffee dynamic in my house. Okay, so this is from Bloomberg here. Hidden bond market problem. More than a decade of easy money has kept the U.S. economy afloat in times of crisis and fueled an unprecedented boom in financial markets. But it's also created a whole new series of risks, especially for savers. Who could have saw this coming? We're going to print a ton of money, and it's going to hurt savers. Who could have saw this coming?
Just look at how long it took them to come to this realization. Interest rates have been falling since what, the 90s?
This is the problem. This is what hyperinflation looks like when everyone decides that they have to take on risk because they have no choice. That's like basically what you're saying is I would rather take on risk than hold on to dollars, and that's where we're heading. But let me go through this article because it's a good visual representation. Where there was once a vast pool of safe debt in which they could park their cash and count on annual payouts of 5% or more, comfortably above inflation, there's little more than a puddle, and a shrinking one at that. In fact, never has the amount of new government and corporate debt paying even modest yields been so minuscule. So we can see here.
Just hold on. I genuinely wonder if this gives a rise to why markets such as the cannabis space saw so much money flow in. And that's largely because it's just people looking for yield. They could care less about what market it is. They're just searching for yield.
Like what are you supposed to do in a market like this, right? So institutional investors and savers looking for a 5% annual interest rate had plenty of new bond and loan offerings rated BB and above to choose from prior to the 2008 financial crisis. These included debt from government-sponsored mortgage loan companies like Fannie Mae and Freddie Mac. Now, of course, we look at this. This is a little bit like let's remember that scene in The Big Short where they're playing with the Jenga and they start talking about how they just started shoving shit mortgages into some of these bonds. So, this has to be taken with a little bit of a grain of salt here, where these 5% bonds included a lot of what should have been considered junk. But that's besides the point. There used to be a lot more 5% yield for fund managers, pension fund managers, for people to go get as opposed to put in equities. Now we look here by 2019, after a decade in which the Federal Reserve kept benchmark rates near zero, the pool had shrunk dramatically, despite the fact that issuance of new debt was near record levels. Debt rated A or above paying 5% virtually disappeared, leaving the vast majority of such offerings rated in the lowest tier of investment grade or worse. We can see this here, down to 330. So
virtually disappeared.
So
what A-rated company was issuing above 5%?
According to this chart, none of us follow the bond market, but look, there's clearly some. You clearly see some.
You're looking at that. That's the original chart from 2008. This is now here.
There's still a few of those green dots. I assuming that those are companies. Look, the Walt Disney Company, they were giving out 5%, $11.7 billion worth. Okay, now after the Fed's unprecedented intervention in the bond markets drove rates down even further in the pandemic, finding anything paying more than 5% has become difficult, except for investors willing to dip into the riskiest parts of the junk bond market. Well, cheap borrowing costs have been a boon for corporate America. The same can't be said for money managers that need to generate returns that match their long-term obligations. So here's the big takeaway that I want to look at here. We look at the top here. We went from, this is 2008, $930 billion of 5% or higher yield down to 131. It's literally down 70%. So the question I ask you, Jason, you're a fund manager. You're managing the Saskatchewan Teachers Pension Fund. You got a mandate. You got to get 7% return. Where are you going to find that?
Well, I can promise you it's not gold right now. Outside of that, I mean, there's a reason money is flowing into Bitcoin and all that stuff.
Okay,
you got to find risk somewhere. That the equity market is slowing down, and what's going to keep going up at this point, right? How are you going to continue to get that yield?
So this brings me to my next article here. Like I said, I planned out today's show. Charlie Munger prefers Alibaba stock to Treasury bills. Here's why. And now
a Chinese ADR, that seems safe.
Well, look, are you telling me that you're a better investor than Charlie Munger? Please.
I don't know. What did you get for returns last year?
Oh, good. This Canadian venture penny stock scab says he's better than Charlie Munger. Oh, boy.
Maybe over a 1 to 2 year time frame, but over the 40 years, probably not. Everyone has a good year at some point in time, right?
So this brings us to that point of where do you go to get yield? Charlie Munger prefers Alibaba stock to Treasury bills. Here's why. So in this article, they're not actually really talking about Berkshire. They're talking about the Daily Journal. Munger served as the chairman he served as the chairman since 1977 and provides the firm with investing expertise. Disclosed last week in a Securities and Exchange Commission filing that it owned 165,320 Alibaba stock or ADRs as of March 31st. The Daily Journal hadn't owned any at the end of 2020. So in other words, it sounds like a theme that we're starting.
Just read that quote. Read that quote.
With this one here?
Yeah.
Daily Journal Corporation has and needs securities held as cash equivalents. These cash equivalents would normally be U.S. Treasury bills, but with returns on Treasury bills now so low, the company instead invests in common stock. And unless its long-term prospects seem good, a common stock is not considered to be a good cash equivalent. A minor part of the Daily Journal Corporation's cash equivalents now consists of a tiny amount of common stock. So what's the big takeaway here, Jason, from reading this article and things to think about when guys like us, we're balance sheet, income statement, cash flow statement nerds, we're now thinking about flows. What's flowing into where and how do we navigate that storm? What's the big takeaway from this?
So to me, now, let me assume that I have things understood correctly. But basically, this is where the markets almost act like a balancing act to a certain extent. Because now you have less people buying treasuries because instead they're going into equities and pushing those valuations higher. So you have less buyers for those treasuries. As a result, the interest rates rise because no one's willing to buy at these low rates. So as a result, it's probably why treasury yields are rising right now.
Well, my big takeaway is that equities are seemingly becoming the new T-bills, and this is the new normal.
Absolutely. But what I'm saying is that works until it doesn't, right? T-bills, the reason that they're viewed as a cash equivalent is because they're so damn stable over time in a normal environment. The last 12 months is not a normal environment. Let's be clear on that. But I mean, something like Alibaba stock, pull up that chart. That's not a stable, right? There's a reason he can't classify as cash equivalent, right? So I mean, that causes problems for the whole system.
Hey, look, I'm pulling up the chart. Patience there, young Jason. Here's the chart. That looks pretty stable to me.
From what is that, 220 to 320 in a matter?
Look, you're right. As a store of value, it's got a range from 155 all the way to 315. So we're talking
your
about
money could literally be worth half or double. That's not very stable.
But the point is that where the key to managing money, and look, I'm not a money manager. This is not investment advice. What do I know? Is that you're trying to be ahead of everybody else. And I think that guys like Charlie Munger, he's kind of looking at this going, okay, look, there's no point in owning T-bills because I can't match the inflation rate, which means I can now have to play this much more dangerous game of trying to find equities or a portfolio of equities that's going to match inflation so that we protect our cash balance. The company needs cash in the future, and cash is becoming worth less and less every day. I want to invest in companies, and I'll tell you right now, I don't know Charlie. We've never sat down and had a little powwow. But Charlie, if you're watching us, I'll happily take your call anytime you want to sit down and talk stock or talk Canadian small caps. Hit me on Twitter. But he's looking at it, and he's looking at Alibaba, in my opinion, and he's saying, you know what it has? It has very high inflation pass through, meaning that the people who are using this are more than likely going to be able to just increase their prices on to the consumer. And Alibaba, from a cash flow standpoint, is probably a pretty good bet in a world where more and more people are getting on platforms. And those models tend to do very well. And B, these are consumer goods where they can just jack up the prices according to inflation. So I think that's why I like the bet.
I find it so interesting that it'd be someone like Alibaba. Do they have holdings in someone like Amazon? Because Amazon would have the same benefits in terms of exposure to inflationary things, but it doesn't have the risk of being a Chinese ADR that, I mean, we saw what happened with Bill Huang or whatever his name is, right? Like I find it interesting that he elected to go with a Chinese firm rather than American.
Mm-hmm. Okay, so let's move on to Mr. J. Powell, as I like to call him. We're buddies. So there's a whole bunch of different headlines that came up last night from his appearance on 60 Minutes, of which I found myself watching the Masters. I'm not a golf guy. I don't like watching the Masters. I think it's incredibly boring. Just in Canada, anyways, there's all these people tweeting about what Jay Powell was saying, and here I'm sitting here watching, them talk about these green jackets.
Didn't you have the first guy from Japan win the Masters yesterday?
Yeah, that was.
Look at that! I'm up to date on sports.
Yeah, that's true. I don't consider golf a sport.
Nor do I.
Anyways, so I'm sitting there. I'm waiting for this event to happen, and sure enough, finally Powell comes on. What does he talk about? He talks about, okay, he doesn't see interest rates are going to go up at any point at any point in the next year. He thinks that the greatest threats are a cyber attack on a major financial institution. And he sees COVID-19 spreading as a big risk to the economy. And that's something that, look, and all this COVID stuff, if we're talking about risk and we're thinking about it just logically without, reading anything or just having a conversation, I think that the biggest risk for myself is somebody, I don't know anything about virology or whatever it's called. But I will say this, what happened in Brazil, the Western world's going to be quick to vaccines because that's just the way the world works, like it or not. That's how it's going to play out. And then you're going to have all these other countries like India, Brazil, African countries where there probably will be new variants, and who knows if the vaccines can actually defeat those. So that to me, I view as the biggest risk as the economy starts to move online. that there's a no variant that comes out that's worse than anything we've seen so far. It looks like Mr. Powell seems to see it the same way. And of course, the cyber attack on a financial institution. But overall, it sounds like they are going to let inflation run hot, and they ain't going to do a damn thing about it. If anything, we may see them throwing more fuel on the fire.
That's interesting. Why would... I don't know why they would truly want inflation to go nuts. I mean, don't get me wrong. I see the whole GDP aspect of that. However, someone like Jay Powell is supposed to be removed from the politics of things. But still, like, there's a limit, because I guess part of the issue is someone like Jay Powell is not really going to feel the impact personally of inflation. He's not someone that's making a buy on a bi-weekly paycheck that he relies on to pay his bills, right? That's just not who he is. And quite frankly, based on the wages at the Federal Reserve, that's not anyone in that situation's lifestyle, right? They're so far removed from the actual needs of society that it doesn't even matter anymore, right? Like, there's places where lumber has just gone sky high to the point that there's been hurricanes.
I'll pull up the lumber chart for us. Look at this.
There's been, I said hurricanes, I meant tornadoes. There's been tornadoes going through the south the last few days. I was watching the National late last night, and there's hurricanes everywhere. Well, how are those people going to actually afford to rebuild? Sure, insurance will cover some, but that's going to have costs. People aren't going to be able to insure their homes after making a claim when it comes out to that much, right? Like, there's places where a 4x8 sheet of plywood is now literally $98 when it used to be like $30 at best. Mm-hmm. And even then, $30 was expensive, right? So you got these people that need to rebuild after natural events, and like it's getting to a point where you start to wonder why they would want inflation at all, right? Like,
I can tell you why they want inflation at all is because they're trying to inflate away the debt. How do you make this massive number look smaller on a relative terms? Well, you make what that is measured in worth less, right? So if you've got if you're doing $23 trillion in GDP and you've got $23 trillion of debt, well, why not do $46 trillion in GDP and $35 trillion in debt, right? So that's
sure that's fine, and that's all well and good, whatever. I fully get that. However, the guy working down at the local Pizza Hut for $7 an hour, you think suddenly he's going to get paid 14?
No, he's not. Right. And that's the thing that nobody really understands about this whole thing is
let's not be naive here. It's these low-income workers that are propping up much of the economy, right? Yeah. People don't like to actually think about it, but it's true.
The perverted thing about it is that they're the ones who've been working. Well, many of us have been sitting on our asses watching soap operas and eating bonbons. It's those people who work at the Sobeys, the Publix, wherever you are, your local grocery store or drugstore, or these places that they tend to pay people low income. Those people, they're not going to see a spike in their job, in their salary or their wage, and they're suddenly going to see all the products around them get more expensive, because that's going to be the way that we pay for this whole thing. And this was a debate we had when Powell first had that announcement of the infrastructure bill in Pittsburgh a couple of years ago. This idea that they're going to just raise taxes. I just don't believe that that's going to happen. I think it's too unpopular of a decision for them to do politically. So right now, it's this whole concept of debt and monetary easing is so opaque for most people to understand that they just choose that when they're trying to come up with their own, like, organizing their thoughts on how they feel about what's happening politically, they don't even go there, and they don't understand it. And when you really think about it, it's pretty messed up that there's people who make significantly more money than that. They're sitting at home doing nothing. Well, those people have to work, and they're actually in real terms going to be making less. So anyways, you guys, nobody who's watching us wants to hear me talk about social issues, but it's something that I find, like when COVID first started, I don't know if I've ever told you this story, but when COVID first started, I was in Orlando, Florida, And I remember sitting down, we took my son out for Dairy Queen. And like we were on our way, cutting our vacation short because it all happened really fast, right? Like it was all like one day it's like, oh, like, yeah, there's this thing going around, but it's, Health Canada is like, hey, there's no big deal. They're actually putting out promoted tweets that it wasn't a big deal. So, we go on vacation 3 days later. It's literally, you better get back home. Like the world's about to end. So we're sitting in a Dairy Queen in Orlando, and I saw this family. They went in and, they ordered a couple of drinks, and they appeared to be from, I assume that they were Mexican migrant workers. And I just remember like just looking at them, like they pulled up in a van that looked like it was about 30 years old. It looked like they could hardly afford to. I'm not going to get into the whole like story of everything that happened in that scenario, but I just remember like looking at them and going like, this is, it's probably gonna be a really hard time for them because where they work might get shut down, and they're probably not going to get any of these checks if they do come in. And I just. Look, I eat a lot of fast food. What could I say? And I interact with these workers all the time. And I hate to see regular everyday people get the short end of the stick. And the worst part is like, they're not really like, look at the news with Amazon recently. And the workers voted against the unionization.
Did they?
Yeah. Like, in Alabama. Yeah. It's insane. It's insane. Like if you're an investor in Amazon, that's great.
I mean, personally, I'm no fan of unions. I'll tell anyone that. I'm not afraid to say it, but that doesn't mean there aren't scenarios where unionization is probably in the best interest of workers.
Amazon's one of those exact scenarios where I think that even reasonable people can say unions make sense. But anyways, that's besides the point. People want to hear us talk about the equities markets. They don't want to hear about my personal thoughts on all these things. But that's the reality is that's how we're going to pay for everything that happened during COVID is we're going to print money. And, those of us who actually have capital assets are going to do quite well. And those who are the labor force will make out poorly. That's the way of the world in 2021. And effectively, that's what Powell said last night. So if you're rich, great news. If you're not, too bad, so sad, I guess.
Yeah, what celebrity was it that wore the shirt that literally just said "Stop being poor"? That's all I think of when I hear Jay Powell talk. Yeah. Like truly.
Is there anything else? I'm probably going to cut it short here. Is there anything else you want to cover today?
Today, no. This afternoon we have on the Daily Dive we got Mike McGlone. It's a great interview. I actually watched it twice, and I'll be honest, I don't always watch the full interviews that we put out because I'm time constrained. But yesterday I sat down and watched this one twice. Mike is a great commentator, and Cassandra did a hell of a job interviewing.
Wow, well, that's good to hear. Cassandra's been working really hard for us, and I'm happy to see it's coming along nicely for her. Is there any big earnings out this week, or?
Aside from Afria this morning, we have Organigram reporting. I believe it's their third quarter results tomorrow, or maybe the next day. Outside of that, we've got a bunch of bigs reporting later this week. I believe on like Thursday, Friday type timeline.
Okay.
If you're interested, I suggest you watch the week ahead video that we put out every Sunday at 5:30. Gives a great summary of what's to be expected in the week to come,
and also from the perspective of us, Canadian venture junkies that care a little bit about what's going on in the broad market. Look, guys, nothing we talk about on the show is financial advice. We're not giving out any buy or sell recommendations. You're looking for that sort of thing? Go find somebody who's licensed, of which I am not and Jay is not. This is for entertainment purposes and informational purposes only. You could have spent your last hour staring at any screen, any place in the world, but you chose to spend it with us. For that, I appreciate you. We will be back tomorrow with more Canadian junior and venture market coverage. Thanks for joining us, everybody. Enjoy your Monday.
You see all the bread, and I know it make you wonder, don't you? I ain't surprised at all. Seen them rise and fall.